So here we say that credit or the loans is the key propellant or the backbone of the economic growth as we march towards to being the third largest economy in the world. And then and historically credit has grown at like 1.4x GDP. So it is a growth sector and hence an outperforming growth sector compared to the nominal GDP with a decent visibility. And of course there is this kind of penetration driver as well. So the lenders are key beneficiaries of that, as our credit penetration is still much lower at less than 40% to GDP in terms of retail, and the hope of corporate recovery continues to keep us excited on this space. And in terms of the health of banks and their balance sheet, so I think they're the best in the decade. They're reporting one of the best ROAs, and as well as they're flush with capital to support the growth that's expected to come from the retail, corporate, and as well as the SMEs. And specifically investing in a BFSI sector fund will give the investors the opportunity to participate beyond lending. So the financialization of savings is a mega trend, so which will get captured through some of the opportunities like the AMC companies, stock market brokers, or exchanges. So the sector fund will be able to capitalize on some of these opportunities, and hence it's a way to get exposure to this mega trend. The third most important in the given scenario, and I think it's been playing out over the last 1.5 years, is the sector valuations have been quite comfortable. So it's in fact it's at below mean. I think they have a chart to show that despite improving return metrics, profitability metrics, and the health of the balance sheet itself. So that gives us a lot of comfort in terms of going overweight on this space. And going back in terms of the over like a 10-year, sorry, over 20-year plus period, so Nifty or the BFSI sector, Nifty Financial Services, has outperformed the Nifty 50 index by 300 pips. So I'm coming to, okay, we spoke about the broad sector and what makes investing in the sector appealing, and hence why UTI, the Banking and Financial Services Fund. So as you can see, there are clearly structural drivers, and as well as the low penetration argument that holds for many segments within the space. And we as a fund try to take exposure to these non-lending segments as well, like insurance and capital markets. The benchmark is pretty lending heavy, so we have exposure to, I think, close to 15 to 20% in this non-lending space over a period of time. And as well as the second bit covers the beyond large cap argument that in the diversified financials, the exposure to large cap banks is pretty high. The sector fund, like us, gives us significant exposure to mid cap and small cap, the niche opportunities where we are bullish on. So I think that's how I would put it, and it's a bottom up portfolio with significant overweights on the smaller and mid cap names where we have strong conviction, which that's what's visible in terms of our active weights that you can see, and I think that's what I would say about the portfolio. And over a longer period of time, I think over 3-year and 5-year period, the fund has outperformed the benchmark. And that gives us the confidence, given where it is in terms of both fundamentally and also from valuation point of view. It's a good place to be in. And I think it aligns with the whole large cap bias as well.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.